Good morning. It is Friday, the 5th of February, and this is the Bitcoin briefing. We've got a few news stories to cover today in the world of Bitcoin, so I'll just jump straight in. Bitcoin for Corporations, the Microstrategy and Saylor virtual event, has gone down a day or two ago, and what seems to have been a huge success, really. 1,400 corporations and 5,600 executives all descended on the virtual conference to learn about MicroStrategy and other CEOs' playbook for purchasing large amounts of Bitcoin, essentially converting part of their balance sheets away from fiat cash into Bitcoin as a hedge against inflation. This is significant for two reasons, really. Obviously, the more corporations decide to put their balance sheet and their nest eggs and their treasury reserves into Bitcoin, then it's going to have an upward pressure on the Bitcoin price. But another advantage for the community is, of course, the huge confidence boost it gives and the credibility. Before a few years ago, if a company director or the CEO had gone to the board and says, "Look, we've got this money and I want to buy Bitcoin with it," he could have lost his job quite easily. They could have sent him off to the funny farm. Now it couldn't really be much different. The race is on for companies to educate themselves, to create the internal company legal frameworks to be able to make these moves. Because a lot of these companies have charters, and those charters will prohibit any investments in this kind of space. So there needs to be a lot of legal work within these companies. So there really needs to be a lot of internal education, a change to companies' legal frameworks, and obviously they need to get stakeholder buy-in. So this is not necessarily going to be an overnight thing. Just because these companies have gone to the conference doesn't mean tomorrow they can buy can start buying Bitcoin. It could take months. It could take a year, but the important thing really is not that they're going to just start buying it now and start pumping the price. As I say over and over again in this podcast, I couldn't really care less about the day-to-day price as long as the annual lows still keep ticking up. It is incredibly volatile at the moment, and it uses far too much mental energy to just worry about the price all the time. In fact, that's why I stopped trading, because when something seems to happen when you add margin onto your positions. You become obsessed. You're like a crack addict, staring at the screen, not sleeping, not eating, just position tracking, and it's not good. It's stressful, and I feel so much better with just the coins in my ledger. So anyway, back to MicroStrategy. This is, it's great news all around. It's good news now. It's good news for the next 6 months, and it's just a continuation of this pattern that we're in, where more and more companies are deciding on an individual basis to, we need a hedge, and this, of course, is the hedge. I'm going to play now the clip of Michael Saylor in his keynote interview with Ross Stevens discussing how both of them have converted their balance sheets into Bitcoin. I will leave a link in the comments below to the full MicroStrategy conference. It's about 5 or 6 hours long. So for those of you that have the time or the interests, enjoy.
You and I are both CEOs. We have a lot we need to focus on. Why should we even care about reserve assets?
Well, I think a CEO has two jobs, right? Executive, but also capital allocator. The first one is obvious. The second is more important. Capital allocation is a CEO's most important job. Cash is now a liability, no longer an asset. And I think that has profound long-term implications for corporations. Learning Bitcoin is like, at least to me, for me, it was like learning a foreign language. You live in Spain for a year, or you live in France for a year, and at some point you get good enough. It takes some time, but with immersion, you think in Spanish, right? You think in French. Something clicks for you. You make that switch. You're not taking me 8 years of morning study and a lifetime of lessons studying the markets. But I now think in Bitcoin, and it's very freeing. And through that lens of thinking in Bitcoin, Bitcoin is not volatile. Fiat is volatile. The price of college is volatile, and fiat keeps getting cheaper. in Bitcoin. The price of prime real estate is very volatile, and fiat keeps getting cheaper in Bitcoin. The price of all of my long-dated denominated liabilities, like a mortgage or retirement, or we do a lot of work with insurance companies, they're long-dated fiat-based liabilities, a death benefit for life insurance contracts or annuity payments. Those are extraordinarily volatile in fiat, and they each keep getting cheaper in Bitcoin. And so to understand really what's going on and why this is happening, I think we need to ask ourselves two things. One, like what is money? Like what is it? And why is Bitcoin an excellent money, or even is it an excellent money? So what's money? Money is technology. It is, and it always has been technology, whether it was seashells or salt. And if gold went to, I don't know, $100,000 an ounce, so up 50x overnight, you and I know what's going to happen tomorrow morning. The miners are going to get to work very early, right?
I'd be mining it.
You and I would drop the phone and start mining, right? We're going to start mining. We're going to look around our house for gold. We're going to melt it down. We're going to drive up the supply. We can't skyrocket the supply, but we're going to drive up the supply. We're going to drive down the price of gold. If during the course of this conversation, people really feel like bullish on Bitcoin and Bitcoin goes to 1 million, I'm just saying that with a smile, what's going to happen to the supply of Bitcoin? Nothing. That's incredible. Bitcoin is the first store of value in human history where its supply is never, can never, will never be affected by any amount of its increased demand. So the conclusion is that Bitcoin is better at being gold than gold because it's more saleable across time.
All right, so pretty fascinating, huh? Let's move on to something that's less fascinating and more annoying. The SEC are looking to investigate Reddit and particularly Wall Street Bets. The SEC, of course, is charged with protecting retail investors from unscrupulous securities traders and products, yet now they seem to be turning their gaze onto the people that they're meant to be protecting. I do feel very sorry for whichever intern or lowly employee has to go through all these posts and try and make sense of Wall Street Bets, because I think for anybody that knows that subreddit quite well, it is incredibly fast-paced. It's a mix of excellent investment advice, memes, jokes, and people just talking rubbish. So, good luck on that. Yeah. And while you're at it, are you going to start investigating Jim Cramer and CNBC and MSNBC and Fox Business? These companies, especially Jim Cramer. Let's look now.
Can you imagine how well that does once we reopen? Fourth, you may think it's overchronological. I think you can't talk about enough digitization. This is heavily linked to e-commerce, which is why I feel bold enough to recommend, oh boy, here we go. Frank Slootman's, baby. Yeah, I am pushing the buy button. Buy. Snowflake. Along with a couple of others I mentioned earlier, Salesforce and Adobe.
He's pumping it. Look, what's the difference between Jim Cramer sitting in his little, his acting chair and pumping or dumping and encouraging people to buy and sell certain stocks? What's the difference between that and then 1,000 people on Reddit that are doing exactly the same? It doesn't really make sense to me. It seems like double standards, but I'm not too worried because it's just a pathetic attempt by the establishment to try and understand what's going on in the market, and it's laughable really. It just makes the SEC look like a joke, really. Mark Cuban, in fact, had these comments. The SEC is a mess. I wouldn't trust them to do the right thing ever. It's an agency built by and for lawyers to be lawyers and win cases rather than doing the right thing. Well, Mark, I drama of Wall Street Bets and GameStop and big Wall Street interests against Main Street is continuing, and it's a wonderful thing. We've talked a lot about this in previous episodes, so I'm not going to drone on about it too much. Okay, so let's move on to our next and final story of the day, which is the Bank of England coming out and saying that businesses and investors and banks, everybody really, has 6 months to prepare until the possibility of negative interest rates becomes a possibility. Now, this is the playbook of these organizations. When they want to do something, they leak before the possibility that they're going to do it, and they kind of, get everybody mentally prepared for that possibility before the possibility becomes an inevitability. Let's read what Reuters has to say. The Bank of England says negative rates options needs more time, focuses on recovery. The Bank of England gave British lenders at least 6 months breathing space on Thursday before negative interest rates are a possibility, focusing instead on the prospects of a post-lockdown rebound in a quarterly update on the economy. Now, negative interest rates is a phenomena that we're hearing more and more about in the last couple of years, I guess, as the financial system, the post-Bretton Woods fiat funny money, monopoly money financial system that we're in, where currency is just floating, printed, and not backed by anything, is falling apart. And as these companies have just printed and printed, and the national debt has got so large that they can't even service the interest, the central banks are forced, of course, to start lowering interest rates into negativity. Negative interest rates, at least on a principal level, would mean that users will have to pay to save their money, and banks will be paying people to lend money. Now, of course, normal people like us, we're not going to get paid to take out loans, but the banks that issue us loans will probably get paid to issue money to you. And any money that you put in the bank, instead of you earning interest, which, let's face it, none of us were really getting any interest recently, but instead of you getting interest, at least some interest, you'll have to pay the bank interest, which sounds terrible, pointless, and is not going to work, especially when people realize that they could just buy Bitcoin. Why would anybody pay a bank to look after their money when they could just buy Bitcoin? An asset which is future-proofed, it's hedging against inflation, it has a track record of growing every year in value against all other assets, compared to keeping your hard-earned wealth in fiat money, which has a track record of year-on-year losing money against assets, and not only that, but you can't even hold it in the bank without people charging you. Who wants cash? Not even the banks want cash anymore with negative interest rates. That's basically what negative interest rates is saying. We don't want the cash. Oh, well, if we're going to have it, we're going to charge you money for it because, cash. 2%. All right, so that is it for today. If you have any more time, you don't have a job or family or things to do, then I really would recommend watching the 5 or 6 hours of Microstrategy's conference and reading more about how the central banks are slowly, turning the tap on the end of the financial system, and making a better case for Bitcoin every single day.